Hey guys, it's Aman
And Christina
from
from
Our
Our
Rich
Rich
Journey.
Journey.
We have to talk about the stock market crash that is taking place. Every week, the stock market seems to be down. In fact, September just ended and it was a horrific month. Just this past Friday, the stock market experienced tremendous losses, with over 60 of the S&P 500 companies hitting fresh 52-week lows. And so for a lot of people, they are thinking, when will the stock market finally stop falling? Well, that's what we want to talk about on today's video, because we think this is a great opportunity to talk about 4 indicators that you should be watching that are tied to the stock market crash.
So just to give you some context about how the stock market has been performing, on this Friday alone, the S&P 500 fell 2.8%. The Dow Jones fell 2.1%, and the NASDAQ fell 3.8%, all just on Friday. And if you're looking at the year, the S&P 500 is down 23.6%, the Dow is down 19.4%, and the NASDAQ is down 31.9%. And we can track this poor activity to 4 factors. And that's what we want to talk about in this video. We want to talk about these factors and how they're related to the performance of the stock market. Let's start with factor number 1, interest rates. Recently, the Fed has steadily been increasing interest rates, so much so that they're at the highest rate that they've been in the past 14 years.
So the Federal Reserve has raised short-term interest rates to the point where they are around 3 to 3.25%. Now, the Federal Reserve is not slowing down. In fact, the Federal Reserve has indicated that they plan to raise interest rates as high as 4.4% by the end of this year and as high as 4.6% in 2023. You see, interest rates play a key role in the stock market and in the economy. Whenever the Federal Reserve lowers interest rates, they are doing that to spur economic growth. And by spurring economic growth, people tend to spend more, businesses tend to build more and expand, and you have all of this growth potential. It is this type of growth that tends to also drive the stock market, because with growth comes expansion and comes profits.
So for a period of time, we benefited from those lower interest rates. But now, like we said, the Fed is increasing interest rates. And when they do that, people tend to spend less. And that also impacts the economy. There's less growth. There's less profits. All of these things impact how the stock market can perform.
Now, there's something else that needs to be mentioned about interest rates, because I think investors are getting too caught up with higher interest rates. You see, interest rates historically have always been much higher than what they've been over the past 2 or 3 years. And so we've gotten accustomed to these very low interest rates. But you see, it is not sustainable to have an economy that is dependent on low interest rates. If the Federal Reserve lowers interest rates too low, that means that they don't have any other options should we run into economic chaos. And what I mean by this is the Federal Reserve really only has one tool to help repair the economy should we run into disaster, and it is their manipulation of interest rates. And so if they keep interest rates too low, should a disaster happen that requires them to lower the interest rate, they can't lower it any further. So what they're doing now is they're also moving interest rates up so that in the future they have the ability to lower them to help repair the economy should they need to.
So we mention this because we say interest rates play a key factor in how the stock market will perform. If you think that you have to wait for the Fed to lower interest rates to what they were in previous years before the stock market will begin to perform well again, we think that is a big mistake, because it can take a very long time for the Fed to get back to those lower interest rates. So we think the real factor that you need to be focused on is when the Federal Reserve will stop raising rates.
And so it is at the point when the Federal Reserve stops raising interest rates that they have found stability in the economy. But this brings us to the second factor of why the stock market is doing so poorly right now. And it is related to interest rates. It is the inflation rate. And so right now, inflation is over 8%, when historically inflation has been closer to 2%.
Now, higher inflation rates affects the stock market because it impacts both consumers and businesses. With higher inflation rates means higher costs. Businesses have to charge more for their products and their services. And as a result, this impacts consumers because it causes consumer spending to go lower. Now, this can create a cycle that is not sustainable. Businesses want to charge more to keep up with their productivity and their profitability, and consumers want to spend less because prices are getting too high. At some point, it impacts the business's bottom line. They do not become as profitable because of high inflation rates. So, in order to have a sustainable economy where businesses are seeing profits and consumers are spending, we need to get at a point where inflation goes back down to the norm, which is between 2 to 3% annually.
And until that happens, the stock market will continue to have volatility. The next thing affecting the performance of stocks are how the CEOs of the companies that make up the stock market are talking about their companies. You see, it's called CEO optimism. And so if you are the leader of a company and you are saying that you have concerns about inflation, you have concerns about high interest rates, and your expectations are low for the future development or growth of your company, this directly affects the stock market. You see, so many CEOs are reporting that they believe that a recession is on the horizon. And when CEOs talk about their companies in this pessimistic tone, it affects how investors invest in those companies.
So it has to do with investors, but it also has to do with the CEOs and the decisions they make for their companies. So if they feel like a recession is coming or there's not going to be so much growth for their company, they're making major decisions based off that for their company. They're laying off people. They're not expanding. They're shifting the paradigm of their company. And that also impacts how investors are going to be looking at that company, at least for the short term.
And so as an investor in the stock market, it is so important that you keep a pulse on how CEOs are talking about their companies. And so this brings us to our final factor, and it is the news cycle and the negative sentiment that is out there about investing in the stock market. You see, right now, there have been news story after news story about the recession, about the stock market crashing, and so many people are scared to invest. And so the stock market has been going down steadily. But we've always said that these are the times when you build wealth, when everyone else is fearful about investing, when the stock market is reaching its lows. You see, you make money by investing in the stock market when it is at its low and then selling it when it is at its high. Unfortunately, people tend to invest in the stock market in the wrong way. They invest when it's at its high, and when it starts to drop and it's at its lows, that's when they sell at a loss. And so at a time like this, when everyone is so negative about the stock market, this is when you can really build wealth.
So we mention all of this because for us, we see so many opportunities in the market right now. Our favorite index funds, our favorite ETFs, individual stocks, we see so many sales right now. And that is where you can get a lot of opportunity in the stock market, but only if you see this as a long-term investment. If you are a long-term investor, if you are consistent, if you are still buying during the dips, you can see huge potential growth when the market recovers.
And so we talk about all of these 4 factors so that you use this as food for thought whenever you are making an investment decision. This is all a part of your financial literacy journey to understand how interest rates, how inflation, how market sentiment, how the CEOs all affect the stocks that you invest in. And use this information when you are developing your overall investment plan. And so if you've liked this video, what we want you to do is make sure to give it a thumbs up, subscribe to our channel, and join the journey.